Well, weak global cues and continued FII selling dragged markets for a second consecutive day where benchmarks shed 1% in trade. The Nifty gave up the 10,700 mark amid sell-off in banks, oil, gas and metal stocks. The Sensex also shed almost 400 points but managed to hold on to that 35,500 level. Mid-cap succumbed to selling pressure post-lunch and ended with cuts of 150 points. The Bank Nifty gave up 27,000 as it shed nearly 250 points. Surbhi Upadhyay is here with us now with a wrap of today's trading action. Surbhi, day 2 for the bears.
Well, yes, second day of weakness persisting on the street, lots of selling pressure and the indices ending at the lows of the day. That really sums up what happened. The weakness was coming in right from the global markets, right from the morning when we got to know of the scale back in the iPhone guidance from Apple. And a lot of that simply kept on sort of going through. So if you talk about today's action, there are really no safe havens. It was across the board selling on the sectoral side of it. I'll give you the stock list to quickly run through what I'm saying. So Eicher Motors, I mean, second day running, there's so much of pressure on this stock. It's lost about 13% this week itself. Today, again, 4.5% gone from Eicher Motors. IOC and HPCL as a rebound in crude oil prices took center stage. These stocks were also on the weaker side. With global growth concerns, there's no let-up in the selling on metal stocks. So whether it is a ferrous name like Tata Steel or JSW Steel or Vedanta or Hindalco on the non-ferrous side, there was all-round weakness. Other major heavyweight drags included names like Reliance Industries, HDFC, L&T. Largely speaking, banks were also on the weak foot or the back foot today. So ICICI Bank, HDFC Bank, SBI, Axis Bank lost between 0.5% to about 1–1.5%, depending on which stock you're looking at. The market breadth was also negative, though relatively speaking, the mid-cap index was better off than the Nifty or the Sensex. The key losers included, again, look at the auto weakness that's really persisting. So Ashok Leyland, again 2% lower, and pressure on a Shriram Transport Finance, the financiers to the auto space as well. That stock was down today. Page Industries and Jet Airways were the other key losers. The only gainers included, of course, Bank of Baroda. The market has taken a very positive view of this merger. And some excitement on sugar stocks. So Balrampur, Dhampur, even Praj Industries were up and about. Well, finally, tomorrow's day becomes very important because we are now approaching very critical support levels on the Nifty. We are close to the 26th December low of 10,534, also close to the 50 DMA. So let's see if the bulls can take an upper hand as we close out trade this week.
All right, Surbhi, thank you very much for joining in with that. We'll leave it at that now. Here's a big CNBC TV 18 exclusive news break earlier today. The central government is working on a multi-pronged strategy to address agricultural distress. This even as it continues to study the feasibility of basic income support for farmers. Now, sources have told us that the centre may instead go ahead with a package aimed at reducing input costs and improving income security for the farmers. Parikshit Luthra has all of these details and joins us now. Parikshit, what are the options that are under consideration currently?
We're hearing from our top sources in the government that the centre is discussing the possibility of bringing in universal basic income, but no decision has been taken as yet. There are concerns in the government. There are reservations with the cost to the exchequer. This scheme would cost about 2.1 lakh crore rupees, and this is a huge cost to the government in an election year. There are officials who believe that the government would be better placed to actually focus on existing schemes and their better implementation. Very soon we could hear the government announce 4 to 5 measures as a comprehensive package for farmers across the country. So what are some of the changes that are being looked at? Sources are telling us that all the changes would be aimed at income security, at reducing the input costs, increasing the MSP of crops, and at the same time provide additional sources of income for farmers across the country. There are also changes being looked at in the Pradhan Mantri Fasal Bima Yojana to ensure better implementation, faster settlement of claims. We are also hearing that the government is likely to include damage by animals to crops in the Pradhan Mantri Fasal Bima Yojana. This has been a demand from farmers across the country. As far as the KCC is concerned, the government is looking at several measures. Number one, to increase collateral-free loans under KCC to about 2 lakh rupees. Also include livestock farmers under KCC. This is something that could be announced in the weeks and days to come. At the same time, push for wider coverage of the KCC scheme. Currently, the scheme covers only about 50 to 55% of the farmers in the country, and they want to extend it nationally to more farmers and bring more farmers under the net. They're also saying that They're looking at converting KCC cards to Rupee cum debit cards so that farmers have more income in their hands, and not just the Raitu Bandhu scheme, but schemes of Haryana, Madhya Pradesh and Rajasthan are also being looked at. And very soon there could be some good news for farmers in the country. This is something that Gajendra Singh Shekhawat, MOS Agriculture, also told CNBC TV 18.
All right, a possibility of some good news coming in for the farmers. Pariksha, thank you very much for joining in with that. Now, in a move that could strengthen the government's arguments against stricter banking regulations, a parliamentary committee on finance has expressed concerns over Reserve Bank's capital adequacy mandate. Now, the panel has also questioned the results of RBI's prompt corrective action framework, stating that it hasn't succeeded in recovery of bad loans. Rituparna Bhuya is here with more details on this. Rituparna, take us through the highlights of this report.
It's a pretty elaborate report. Let me start with what it has said on CRAR, saying that the current CRAR norm of 11.5% is unrealistic and unwarranted. And, if waived, then this will release at least 5.34 lakh crores into the banking system. The report has expressed concerns on several counts. Firstly, of course, on increasing loan write-offs and also on decreasing deposits in public sector banks. But while saying that, it has said that the present crisis is transient in nature and should not become an alibi for privatization. As far as HR issues are concerned, the panel has said that the climate of fear and uncertainty should not be created amongst bankers, because that will be counterproductive. And unless there is a proven quid pro quo, criminality of bankers should not be presumed. As far as NPAs are concerned, the panel has said that NPA should be divided into two different sections. Firstly, NPAs by willful defaulters, and NPAs that has happened due to extraneous reasons, which are not which has happened because of factors which are not under control of different businesses. As far as the PCA network is concerned, a lot of criticism has come as far as this panel is concerned, saying that the intent of the PCA framework has not been achieved, and that has happened because parties with NPAs have no motivation to pay back. It's a pretty elaborate report. It remains to be seen how the government now what portions of this report the government accepts to implement or take forward, or at least initiate a dialogue with the central bank. We'll have to wait and watch for that. With that, it's back to you.
Absolutely, an important report there coming in on the banking sector. Rituparna, thank you very much for bringing us all of those highlights. Now, staying on with that space, banks have also written to the new RBI Governor, Shaktikanta Das, on the issues faced by the banking sector. Now, these issues range from the February 12th circular on NPAs to the IL&FS case and the MSME credit flows, and also the ATM upgrade guidelines, to name a few. The banks have asked RBI to do away with the one-day default rule once again and allow financial resolution to start only after 60 days. If the resolution fails, banks have said, then the NCLT referral must be allowed after 60 days instead of 15 days, which is currently stipulated in the Feb 12 circular. The letter also suggests that the resolution plan under the Feb 12 circular should be approved with 66% majority of the lenders versus 100% majority of the committee of creditors. And banks have also asked RBI to allow standstill agreement as far as loans to the IL&FS group is concerned, which will avoid almost 60,000 crores, a substantial portion of the 60,000 crore rupees of loans given to the group, from becoming non-performing assets. Lastly, the letter also seeks relaxations in ATM upgradation guidelines that are set to kick in by March this year. On all of these issues and more, we understand that the industry body of banks, that is the Indian Banks Association, will be meeting with the RBI on the 17th of January. Now, moving on, fresh investments into the economy have stagnated to the lowest levels in the last 14 years. That's the crucial finding of a report released by the Centre for Monitoring of the Indian Economy, or CMIE. In the third quarter of this financial year, the report says new investments dropped to 1 lakh crore rupees, which is the lowest since mid-2004. And that's not all. The rate of stalled projects also continues to be high at over 3 lakh crore rupees. We spoke to Mahesh Vyas, the MD and CEO of CMIE, and he says that the trend of falling investments is not new and it has been ongoing for the past 2 to 3 years. He also added that demand is a bigger problem for the stalled projects rather than funding.
Capital goods companies could be doing well, and we will not dispute that. The numbers at a macro level for investments are, as you rightly put it, sobering. So we see new investment projects being announced actually falling, and this is not a plunge. It is not a sharp decline, but is a part of a steady decline that has been happening for the last 3.5 years. You see this, this increase in stalled projects and decline in new investment projects leads to a fall in the outstanding projects itself. So we are seeing the stock of investments on hand actually having fallen and fallen quite a bit. If you really have a very difficult balance sheet, then obviously you have a financing problem. But if you have a decent project, then nobody says that financing is a problem. The recent refinery that got stalled because it had land acquisition problems, and it just couldn't get off the ground. A lot of projects have been commissioned already, and capacity utilization is still low. So the expectation of capacity utilization rising, what we saw in Obicus in June 18, has actually come down again. So the problem is more to do with demand.
All right, on that note, we'll slip into a short break on the show. But coming up next, it's a setback for the Nestle company as the ghost of Maggie Band resurfaces. More on why that is when we return.